Hey there, it's Scott, and welcome to the Beating the Market videos. Now, what does beating the market mean? Well, we've talked about it before, but someone did ask the question. I think someone asked the question. I might have dreamed that someone asked me a question. But beating the market to me is beating the S&P 500, and the S&P 500, as I sit and talk to you right now, is negative for the year. So anyone, anywhere that has a system that's even 1% positive, or even a tenth of a percent positive, is one of the best traders in the world, right? It's been a rough year of trading, but the market to me, and the thing that I'm trying to beat with these videos, is the S&P, which is down, down, down. Now, that aside, we're going to talk about overcoming obstacles with the Keltner channel system. Won't that be fun? Three things today. We're going to talk about, can we actually time the market? We might have talked about it before. We're going to talk about it again, and you'll hear why. We're going to come up with a new option for an old trading system we've talked about, and you don't know it yet, but that is hilarious. And number three, is it profitable, this new system? And what are our options? This is, oh my gosh, it's so funny. Disclaimer, please do not risk anything you can't afford to lose, and these are hypothetical numbers, not numbers from my real trading account, okay? It's a disclaimer. We're just trying to get better and beat the market. All right. The market is efficient. I've talked about it before. I've actually written about it. I get angry about it, and we've dropped it, right? It's over. We don't need to talk about it anymore. Except I just watched a video about 48 hours ago from a quasi-famous webinar presenter, and they said that the basis for all of his strategies are the efficient market, because the markets are efficient. They are? Really? Now, proponents will say that books have been written, and Fama wrote that book, Random Walk, or whatever it's called, Eugene Fama, Malkiel, whoever. Sorry if I'm saying their name wrong. I'm very, very sorry. Please don't yell at me. Random Walk Down Wall Street is supposedly the proof that markets are random. But meanwhile, while books are being written and studies are being cited, real traders are out there making real money. I mean, it's the efficient market hypothesis is, dare I say, kind of laughable. To believe that is, you have to take a lot of mental gymnastics to believe something that's clearly not what happens in the real world. But there are studies. If you want to find a study that makes you believe in the efficient market, which I don't know why you would, there's also this problem, a very famous study on studies, why most published research findings are false. People have biases, and they tend to give us information that may not be life-altering. So, that all being said, I am not an efficient market hypothesis believer. Okay, fair enough. I don't think there's a compelling reason to be. Anyway, if we foolishly decide to beat the market, which you can't do, I guess that's the real point of this. If you believe in an efficient market, beating the market is impossible because it's efficient. So it's never possible to beat the market. It's the genesis of this entire YouTube channel and everything I do forevermore. Well, I believe it can be beat. I believe this is a game that can be beat. And so I'm foolishly going to decide to try. Now, as I mentioned, I listen to webinars. I love listening to webinars. I love learning. Sweet learning. I listened to another webinar from a famous options trader that talked about timing his entries. Like, how do you make money using options in their massive leverage? How do you do that? Well, he was talking about doing long calls. Now, I've only been studying options now for a short while. I am considering doing some options talk on this webinar, maybe. But anyway, I'm interested in options. I'm fascinated by them, and I love to learning. So he was talking about specifically going long in the options market using long calls. I know it's buying a call. Don't get me on the lingo. I make my own lingo. And when I think of going long and using options, I say long call, long call. Anyway, he was talking about timing his entries to make big money going long or directionally. okay? And he used a system, strangely enough, he used a system very similar to one we've already talked about. He used in his presentation Keltner channels, okay? Well, let's get to that system. Now, if you don't know, Keltner channels are probability based, meaning price normally stays between the channels. That's what it's based on. Most of the time, the market is just kind of wandering sideways, doing nothing. And most of the time, price will just go in a tiny, tiny range. Well, tiny is relative, but you know what I mean. When price gets out of those channels, something extraordinary happens. And in our system, when price breaks out of that channel, that signified a trend, and we would get long eventually and then hold our position. Well, this particular options trader used Keltner channels, but differently. He went long when it went down. Price should stay inside the channels unless it's extraordinary. And he said, well, if it goes down, that's extraordinary, and it's probably going to snap back. Okay. If it moves down, it's out of the ordinary, it's going to come back to the mean. Okay. Especially, and this is crucial, if the stock or whatever you're trading, ETF, is in an uptrend. If it's in an uptrend, confirmed uptrend, we'll talk about how we do that, and it goes below the Keltner channels, that's out of the ordinary, but the trend is up, guess what the price is going to do? Well, he claims that it goes up. And he uses Keltner channels because they're not as volatile, and I agree. Bollinger Bands are almost the exact same thing, but Bollinger Bands, ever notice them? They get wide, they get very bubbly, they get huge, and then they get real thin. They're very, very movable, right? I like Keltner channels because they don't change that much. It's much more consistent, much more calm. It's just a preference, and that's the system he used anyway. So why would an options trader care about probabilities? Well, options deals with a lot of probabilities, as all trading does. Okay, as all trading does. But an options trader like him is interesting in something, quote unquote, snapping back. We need something to get back somewhere fast. Okay, because if you're trading options, obviously you care about time. You have a limit. If you're doing a weekly option, then it's got to happen in a week. If you're doing a monthly option, it's got to happen in a month. 3-month option, get my point. Options traders need something to happen, and they need to happen right away. So he's going to prefer a system as an options trader doing long calls. He's going to prefer something that, in his mind, snaps the price back, gets us right into profit before the option decays, and he can make a good amount of money. Okay. Options trading is making a bet with a time limit, right? If you're doing this sort of trading. So we need to be right. We need to be right now. So that's why he chose it. Okay. That's interesting to everyone, right? Don't we all want a system that makes us right fairly quickly? All right, here are the rules. And again, all of this is in the weekly newsletter. It's free, no sales pitches. Just get on the list. Okay. Anyway, we need price to close below the Keltner channel. But as that happens, we need price to be trending upward in a confirmed uptrend. This is for long. If you go short, then that's obviously reversed. Okay. We need price to be trending upward. We need it to be above our moving average. And typical monthly expirations are 30 to 45 days, right? Options traders, right? So we're looking for a holding period somewhere in that 30-day or less range, right? We want something that gives us statistics on something we'd actually do if we were doing it with options. Now, options can be traded on ETFs. There are a lot of advantages trading options on ETFs. Won't get into that now, but he chose the SPY. So it's not only is SPY a proxy for the market, which is the name of his YouTube channel, but it's also a great way to trade options. Okay, here's the trade example, right? And this is not a Tuesday system trade example. This is the Keltner trade example. And I stole this slide from last week's presentation, and now it's fixed. Okay, moving on. Price moves down, right? We're in a confirmed uptrend. Look at that, look at that, look at that, right? On our options Keltner system, we have our moving average, price is above. So we're in a confirmed uptrend. Now, what is moving average? Of course, it's in the newsletter, but it's either 50 100, 150, 200. This trader loved 50 and 100. I like 50, 100, 150, 200. I love those round numbers, all right? Somewhere in that range. So anything between 50 and 200, I think you can find great success at, all right? This one, Keltner channels was set to 16 in this particular example. In my testing thus far, I like Keltner channels with a length of 16 to like 22-ish. I think standard it comes at 20 with an ATR range of 1.5. You can see they get a little bit wider at times, but they mostly stay consistent. All right, price in a confirmed uptrend, and it closes outside. Aha, something is going to happen. We want to then enter a long call. We want to get long this option by buying call. Okay. Then we want to hold it and use the exponential leverage of options to make a massive win. That's what he's looking for. You can see that this thing snapped back. That's a daily chart. Snapped back pretty quickly, and we started getting into profit really the next day-ish, right? Next couple days, and then it got vicious, and then it could maybe get out here, but it went farther, and then our holding period was in that 20 to 30 day range, which is right about here. You can see it got in around June 25th, and it got out right in the middle of August too, so it's not quite 30 days for this one. Again, for the exact numbers, it'll be in the email newsletter. Okay, now check this out. Price is in a confirmed uptrend. We get a huge drop in October here, right? This closed outside the Keltner. We'd start negotiating our option price with the market. Give me a long call. And then what happens? Well, it's a losing trade. If we're trading trading this straight in the market, and by the strict rules of the system, you bought it here and you sold it when your time expired, right? We're having a timed exit on this. Well, look at this. Look at the snapback. Boom. Huge down day. We initiated our position, allegedly, and look at that snapback. What would the profit be? Well, we'll never know because we don't know what the prices were live at that particular moment. But oh my goodness, I bet that was a decent amount of money. And then it went down. And the other nice thing about options is there is no stop loss, just time. I mean, you can create a stop loss and say, I'm getting out then, but there's no official stop loss. It's just over when time ends. So this means nothing. And then, boom, it comes all the way up to the upper Keltner. So we could have gotten profit here, could have gotten profit here, right? Even, no, wouldn't have had profit there, probably. Again, we don't know for sure. So this is a losing trade on our research, but how many times could we have gotten a nice profitable trade? Well, a handful of times, right? Boom, 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 maybe there, got it. And if we even held on a little longer, we got more profit there, right? But that's a system, and that's what he's trying to do with options. When it confirmed uptrend, going long, closes outside, and then we're trying to get in and hold it for a quick snapback rise, okay? Bottom line is this. This is similar to our other Keltner channel system, except now we're waiting for it to break below where before we did it on a breakout. But there is profit there. And if you want to know how much profit, again, it's in the email. But it was nicely profitable. Actually, it handily beat buying and holding the market over the period tested, right? Since, I mean, it was a number of years, couple decades I went back and tested, right? So sorry, efficient market. Doing just a simple system like this, waiting for it to break below, beat the market by a substantial amount. Was that luck over 20 years? I don't think so. Does that mean the markets aren't efficient? Anyway, the point of this, though, is that an options trader uses this system because he wants it to go his way quickly. At least in the few examples we looked at, it did come back quickly. Check it out on your own, right? And like I mentioned, using options without that hard stop and using the exponential leverage, we might have gotten nice winners way before the time exit was over, okay? But you'll see the numbers. It's fine to trade just like it is, right? I give you all the inputs. You could trade the system on the charts just as it is. The problem, because we're waiting for a confirmed uptrend and we're waiting for extraordinary circumstances below the Keltner, you don't get a lot of trades because we're also holding it for 20 to 30 days too, okay? So if getting a lot of trades is a problem for you, then that's a problem, right? But the fact we didn't get a lot of trades, I think there are ways to solve that. And oh, guess what? The further emails this week, we will talk about exactly that. All right. Latest updates, you can always go to scottwellstrategies.com, and there's the contact information. We have a Keltner system built for options, and now we have options on ways to trade it. That's still funny. All right. See you next time.